Good afternoon and welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is a special guest, Brian McGeehon.
Thanks, John. I know Aaron's photo's popping up, but unfortunately it's me.
Hey, well, Brian is the Chief Financial Officer for Gatewood Wealth Solutions and a lead advisor. And Brian also has a chartered financial analyst, the CFA, which is the gold standard certification for portfolio management. Well, the news hitting the headlines this week is the increasing number of daily new COVID virus cases. Anthony Fauci warned yesterday that new cases could go up to 100,000 per day if guidelines for social distancing and face masks were not followed. The question is, what impact will this have on the market? We will get into this in more detail in your presentation, Brian, and in our questions and answers afterwards. So, Brian, can you give us a brief update on the market and what our investment committee sees?
Absolutely. And thank you again for having me on the call. Typically when you guys invite me on the call, I'm giving bad news. Usually you guys, bad quarter, you send me out. So I feel very good that I get to be on the call when we just came off one of the best quarters in stock market history.
Pretty incredible, isn't it?
Yeah. So, continuing with the theme that, from Aaron, let's look at the timeline again. So comparing from last week, the big focus on this timeline are going to be on the state restrictions. The other items are still on track. But we're going to be really focusing on the restrictions and the effects of this during this call today. So looking at, as you mentioned in the headlines, the new cases in the US, you're looking at the trend. It's very clear that the new cases are on the upward trend.
They're climbing rapidly.
It is climbing rapidly. And the trend is not changing at this time from what we're seeing. Now, we expected this to happen as they're continuing to ease the restrictions in some states going into the third quarter. And as Aaron mentioned, that these next 2 weeks are going to be really critical because one of the things that we're looking at are the daily deaths.
Yes.
We know that there's a lag that takes place, but this lag, we should be seeing these daily deaths start to increase because it's been a couple weeks now of an increase in new cases. But as you can see in the trend, we're still in this downward trend for daily deaths. So next couple of weeks, we're really going to be seeing, is this trend going to hold or not?
So it seems like the thing that Aaron was talking about last week, and which we talked about before the call today, that while the cases are increasing, and even during the time period where they were kind of flat, the deaths were still decreasing. So our goal is to see whether or not that trend continues. In other words, that there's a wider gap between the cases that are occurring and the deaths that are occurring, which would actually be great news for the economy.
Absolutely. And I mean, there's a lot of people that's commented on this already. And as you can see, the recovery rate's just a lot higher. Many believe it's because doctors and hospitals are just handling the virus much better today than previously. The other belief is that now COVID's going across the younger generation, which tends to the younger generation doesn't have as high as a fatality rate as the older generation. But again, these are trends that we're going to continue to monitor. What I also wanted to go and put up on here we have a lot of engineers as clients. So not only do we want to show a graph, we want to see the data behind the graph. And, I thought that this gave a really good chronological list of the daily deaths. So that way you can also see this daily deaths have been decreasing over the last several weeks. One of the other hot topics is the hot spots.
Right. There you go.
This is all of the news. So many of the southern states are having increased COVID cases, and many of the southern states are also imposing restrictions. So we're seeing, Florida start closing down the beaches for the holiday week. Texas are now imposing restrictions around restaurants. And we're actually seeing some of the northern states be proactive in implementing restrictions and the delay on reopening. One of the questions that I often get from the clients are, if we start to see this death rate start to increase, well, what's going to happen? And this was in the New York Times, I believe, or no, this was in the multi-state. I found this online. Each state is handling COVID very differently. So some states like Florida and Texas are handling it by becoming a little bit more restrictive. Other states are continuing to move forward with their opening of the economy. I really believe, and the investment team believes, that it's really going to be on a state-by-state basis, and we're going to have to look at the governors of each state and see which ones are more, I would say, pro-business, or tend to be more conservative when it comes to things. So we haven't seen any unilateral policy across all the states at this point.
So it seems like, at least in the aggregate, the economy is still continuing to climb, but you're going to have some regional hiccups, perhaps, depending upon how the governors react in terms of either making it more restricted or not restricted, is what you're saying.
Absolutely. I think that's spot on. One of the biggest things that happened over the last week was that GDP, the estimate for Q3, there was a huge revision that took place. So they actually increased the GDP estimate in Q3 up by 3.4%. So now it's in positive territory. And they also updated the GDP estimate for the Q2 by 2.7%. Now, this came from the New York Fed, and they said that most of this had to do with an improvement from manufacturing and the personal consumption. So when I was talking to the investment committee about this, people are feeling much better, and a lot of people have put off big purchases here in the Q2, and as well as traveling. Now it's nowhere near where it was before COVID, but I do think that people are becoming a little bit more comfortable, and and that's showing up in the data too. The famous recovery slide that Aaron often talks about. So looking at the shape of recovery, we're still following this V-shaped recovery. When I'm looking at this slide, and I'm looking at it from a technical analysis point of view, there's two things that are popping up that we're noticing. The first is the 50-day and the 200-day moving average. So you're starting to see a potential crossover point. This is important for people that trade on technicals, and this is an indicator. If it ends up crossing, this is a very bullish indicator. The second thing is going to be this support line right around 3,000. So these ups and downs little swigglies are called candlesticks, and it's hitting the support line, which means that what we call being tested. So that's something that we are monitoring. If the S&P ends up going below 3,000, the next support line is going to be somewhere around 2,700. So those are things that we're watching as far as from the technical side.
What does that exactly mean when you say that there's going to be this crossover? And how should an individual investor interpret that for their own needs?
A lot of this has to do with institutional investing. So there's traders that trade off technicals, or they follow some type of momentum strategy. We follow, a momentum type of strategy as well. But a lot of the technical traders, they're looking at these charts and they're making decisions. So when they're seeing the 50-day moving average going through the 200, that ends up being a positive buy signal for them. The same thing as when you're looking at entry and exit points from the market, we're looking at, okay, well, where's the next support and where's the next resistance level? So it's from a more of the technical trading point of view on the institutional side.
Got it.
The other big event is the Treasury and the Fed met yesterday, and it was a really interesting call. The takeaways from this is that there's some optimism about the economy, and it's expect to rebound here in the second quarter. Now, some of the Fed language coming from Powell, I'm going to read this quote. It says, "The Federal Reserve is strongly committed to use our tools to do whatever we can for as long as it takes. So to translate that, what we believe, that means that they're going to keep on printing.
Right.
So this stimulus is going to continue. I think that there's a pretty good probability that we're going to continue to see more stimulus come out here.
Well, I think that's an important point, because one of the questions we get is, well, what happens if we have another outbreak, or if we have a second wave, or another lockdown? I mean, without that, you could certainly expect that the markets could go down like they did back in March. But the Fed, as you say, they're really committed to do whatever it takes to keep market support. So I think from an investor standpoint, wouldn't you think that would give them more confidence that we're not going to experience, at least in the short term, some type of big collapse the way that we did back in March?
I would agree that it's going to provide a lot more optimism around liquidity. So unlike 2008, where there was a lack of credit because there was no liquidity in the market, I don't believe that that's going to be the case, just because the Fed's going to come in and flex their balance sheet for that.
Right.
So more to come. Looking at the theme, there's really no change from last week on the theme. When I connected with Aaron, the theme is continuing. You know, Aaron gets one vacation every 5 years, and it ends up being this week. So I did check in to make sure that there was no changes in theme. So, you know, our theme is still around inflation. We're still favoring equities over fixed income. We're still very much favoring U.S. domestic equity and technology. So there's no changes in the theme, and there's no really changes to our cash management philosophy. However, looking at the asset classes, we still have the same tactical allocations as last week. There was one trade worth commenting on the wide moat model. We did sell Berkshire Hathaway and we moved to Caterpillar. However, you know, when we're looking at it, that was more of a strategic change. That wasn't an asset class type change. One of the things I did want to go over to was this next slide, which was the relative strength slide. This is kind of a busy, you know, slide. However, when you're looking at this, you're looking at green and yellow. There's been a lot of movement, especially there's the NASDAQ. It's coming off, you know, it's doing extremely well. It's getting a lot of momentum. And a lot of the asset classes to date right now are have a lot more momentum going from than the S&P 500. So they're above the S&P 500 line. So we're seeing that in NASDAQ, we're seeing that in large cap growth, and we're also seeing that in emerging markets. So I talked to Chris and Tao earlier, and these are things that they are monitoring. And as this trend continues, you know, we could, you know, expect probably some changes down the line.
The Q&A, well, so what are you hearing from clients, Brian? And that's why it's interesting to have you here commenting, because you're the one who's talking to clients every day. How are they reacting as they read the news each day about the developments around the coronavirus? And what are you advising them?
You know, over the last couple of weeks, it's been, let me actually turn this slide down. Over the last couple of weeks.
That's your family's.
Yeah, that's my tribe there. 3 kids under 6. All right, there we go. I'm following the instructions given by Melissa here, so apologize for the little gap there. Over the last couple of weeks, the conversation from the clients have moved really from COVID to the next election. I feel like in a lot of our conversations, a lot of our clients are pretty fatigued about the conversation around COVID. I'm not saying that they're not concerned about COVID, but it seems like the biggest theme right now is that people are concerned about the next upcoming election. And that's been more of the talking points that I've been asked from the client point of view.
Do you think it's because they've been getting enough information from us so they really have a good handle on what to expect from a market standpoint, and that they have confidence that things are going, that they're being managed well, and that this is the next new thing that is provide some type of uncertainty. Is that kind of what you think, or
Absolutely.
how are you advising clients?
I mean, there's a lot of uncertainty, obviously, and I do think that, you know, and you remember 2016 with Trump versus Clinton, you know, there was a lot of uncertainty then, but there's been when you combine COVID with the election, with all the other events going on, you know, there's just a lot of uncertainty. And I think that clients right now, they are concerned because the amount of uncertainty. And I do think that from our, the business point of view, I do think that we'll need to start looking into providing some more education around the upcoming election, what our thoughts on. So I do think that that's something that we can continue to focus on, improving our communication there.
Let's talk about cash planning with regards to one's financial plan. Should we be taking chips off the table? What are you advising clients in that way?
So I feel like we've been able to handle the uncertainty this year because we have a great cash management strategy. So our clients, the clients that I've been talking to, even though they've been concerned about the market, they feel very good because they had that 24 months of cash. And I'm often asked, you know, should we take on more cash? And when we're looking at the theme out there, one of our biggest concerns is the risk of purchasing power. So one of the biggest obstacles or challenges is that we can't be sitting on too much cash at the same time, because one of our goals is that we need to have a positive return net. So net inflation, net taxes, net fees. Therefore, when we're looking at cash and we're doing that exercise from a planning standpoint of view, I do think it makes sense to have that 24 months of cash. But however, on the investment point of view, I do think that we don't need to carry a lot more excess cash than that because of, you know, long-term economic markets.
So are you saying that each client should be evaluating their cash target? If they're below whatever that target is, that this would be a good time to raise that cash?
Absolutely.
Now, what about clients that have excess cash? Should they be putting that money into the market?
So that's a great question. And you remember after like 2008, how many clients, you know, are people, not so much our clients, but people that we talk to, they moved to cash and they sat on cash after 2008. And they were waiting for an opportunity to put it in, you know, a time where there was not uncertainty to put it in. And that is always one of the biggest risks because, you know, there's never a point in time, and there's times where there's a lot more uncertainty than others, but there's never a point in time where you look up and there's, you know, blue skies, there's no uncertainty. And the risk of holding on cash for long periods of time is the inability to find a good entry point. And then years go by and you miss out on all that compounding. So, you know, what I try to explain to clients is we need to take a long-term point of view on this. And if they are sitting on cash, we need to strategically add cash in throughout the year. We don't want to all put it in at one time, but over a couple months. Because when we're looking at the model and we run these studies, obviously, if you can time the bottom, that would be amazing. However, you know, when we put that next to dollar cost averaging over a couple of months, over a 10 to 20 year point of time, it really does not make a big difference. So again, we want to protect against the client that moves to cash and sits on that cash for multiple years, because I think that ends up being the biggest concern.
So now, from a business perspective, you're the CFO, the Chief Financial Officer at Gatewood Wealth Solutions. What types of things do you do to prepare the company for times like what we just experienced?
You know, I've been very lucky to have good mentors throughout this. I remember one of those conversations we had with our consultants with Ray Shafani with ClientWise out of New York. We're sitting there about 6 years ago, and he was describing to me, we use ClientWise for some of our organizational processes and our growth strategy. But he was describing to me the average financial advisor and how most of them, in most firms, they don't, have good processes around, paying the owners a salary or having budgets and forecasts or anything along those lines. And, I feel very lucky that, with retirement planning and business planning, what we're looking at doing is protecting its risk. It's risk management. So one of the biggest risks that business has is the lack of liquidity and credit. And we saw that over this COVID. How many businesses did not have enough capital to last for 2 to 4 weeks? There just wasn't there. So what we do is that, we're very disciplined. We forecast, I stress test our revenues, I stress test our business model. Now there's always black swans, of course, but what we try to do is to try to anticipate these things. So that way, during COVID, our revenues went down, but our demand's up and we were okay. So those are the processes that we have in place. And I take this extremely serious because we have to be prudent. If we're not prudent, then, and we're sloppy with that, we put our company at risk, which puts our clients' goals at risk. And that's something I never want to go and put on the table.
Well, we were talking a little earlier about how the average advisor operates. And that the average advisor doesn't pay him or herself a salary. The average advisor simply hopes that there's enough money coming in to continue to pay the bills. And it's not that it's good or bad, right or wrong, but our goal was to make sure that we created a firm that could support families of future generations. So if we're at financial risk, then we're really putting our clients at risk, right? Because we're promising them this ability to be there for future generations. So you're doing a great job. But how would you comment to people who do ask about, well, how is this with other advisors that they're not operating in this way?
I would be, if you're talking to an advisor, I think it's just good business to ask, what is your succession plan? What is your downside strategy for your business? I think those are just great questions to ask. And I think what most people will find is that there's a lot of people that work in the business and there's not a lot of financial advisors that work on their business. And, we saw that across the board. I mean, we see a lot of advisors out there and we're getting calls from a lot of advisors out there where they want to stay focused on the client relationship, which is amazing. And, you need to be able to have enough scale to have a team that can focus on building the business and making sure that you have those good business processes in place. So I would encourage, to reach out and talk to the advisors about, well, what is the succession plan? Walk me through some of your processes just to ensure that they have that in place.
Another thing that we were talking about earlier is that many of the financial publications say typically that as investors get closer to retirement, that they should become more conservative in their portfolios. In other words, that their allocation should be more focused on bonds than on equities. The problem is that bonds aren't paying anything.
Yeah.
And I mean, I think about my own parents, how when they were retired, they had most of their money in CDs. CDs were paying 5-6%. And really that was their source of income, was the income that they would get or the interest they were paid from bonds and CDs. Since they pay so little, how are you advising clients in terms of their allocation and where should their money be and how do they generate that income?
Well, I think there's a disconnect between a lot of times investment strategy and financial planning. And I say that because we had a client whose mother, and this is pretty typical too, came in and, we're looking at the allocation and she's like in her 90s and she's done an incredible job saving money. Mathematically, she cannot run out. It's just not going to happen. She's never going to have it.
Market drops by 50%. She's still not going to spend it all.
She's saving money. So, and from you're looking at the allocation and, it's full bonds, full cash. And from an investment management standpoint, that's not bad. But what you find is when you're asking questions about what is the purpose of this money, what do you want to accomplish? You quickly find out that this money is not for her. In her mind, this money is for her kids and her grandkids. And automatically you're looking at, what's the time horizon? There's no longer a 4-year time horizon. There's a 50-year time horizon. And that calls for a different type of allocation. So I find that a lot of clients that we're talking to that have done a great job saving their money, it wouldn't be abnormal to see an 80-year-old holding, who's done a good job with 100% equity allocation. And it's not because of their age, it's because of what they're trying to accomplish based on what's important to them. So,
well, if they follow the simplified rule book for financial planning for dummies, they say if you're in your 80s or 90s, you should have CDs.
Yeah.
So what you're saying is that really that's a simplified view that doesn't really take into consideration all the factors.
Yeah, you have to take in consideration how much assets they have, how much they're spending, their risk tolerance, of course. But, one of the things that we go through with the CFA is that, we design portfolios to meet a series of cash flows. That's all it is. We're matching investments to a series of cash flows.
Just like a pension plan.
Just like a pension plan. And we have to understand when they're going to need for cash. And then there's obviously risk management involved in there as well. But, going with the simplified model, you end up not having the optimum portfolio, which is a shame because in this tax system, we have an incentive to, have a stepped up a basis at death in some of these assets. So you want to take advantage of the tax incentives out there for growth because that provides a greater legacy and usage of that capital for their families.
Well, the interesting thing is that CDs, the interest you earn is taxed at the highest rate.
Yeah.
So it's really not very tax efficient, actually.
Yeah.
So I want to talk about another thing. We see that in the financial markets that mortgage rates are going down. They're down to historic lows once again. In fact, I got a flyer from my own mortgage company the company that I have my mortgage through, that they suggest that I go and refinance through them,
Yeah.
which I don't quite understand why they want me to pay them less than what I'm paying now. But what are you advising clients, and how would they know whether they should go and refinance today?
Well, we were in the same boat. My wife and I, we bought a house a couple of years ago, and it was at that time a pretty good interest rate. And then since then, it's just been on this downward trend. So really, it becomes a math equation. We have to understand how much closing costs are, and these are things that our firm can be more than happy to help. I do think that if you're above 3.5%, it probably does make sense to revisit that, and let's do some math to see, okay, well, when's your break-even point? Because I mean, you don't want to say that it can't go lower, but a 3% 30-year mortgage, I mean, that's pretty ridiculously low at this point. So it just becomes a math equation.
So I want to go back and talk a little bit about the advisor concept or matter that we were talking about, because most advisors are they don't really have a succession plan. And one of the things that we've done is we built the firm to actually help some of those advisors. And I want to put this in perspective. So for example, if an advisor is working for Merrill Lynch or JP Morgan, Morgan Stanley, Goldman Sachs, they all have a problem. The problem is that their workforce is aging, and they don't want to lose the assets when the advisor retires, and the advisor wants to be paid for those assets. So they have these succession agreements that they've bought into and are assigned with the firm, so that when the advisor retires, Morgan Stanley, Merrill Lynch, all these firms will buy the book. The problem is, while that might be great for the advisor and the firm, what about the client?
Yeah.
You know, from my experience, what we see is that those clients go into these call centers, or they're assigned people that they don't even really know or have any experience with. Imagine if that was your family. So what we're here making available is for those advisors as an alternative, if they would like to make sure that their clients truly have a good experience beyond their relationship, we will take that opportunity to go and offer to buy their firm, their practice.
That reminds me of, obviously we've been able to help a lot of advisors today. And I got this letter. It was from one of the clients that got transitioned. Like we went through this entire transition process, and he showed me this, and it came from like a service center. It says, "This is your new financial advisor."
Right.
And I'm thinking, I'm like, well, that's not how that works. I mean, your financial advisor is someone that you build trust and
Right.
respect. It's not something that you can just assign to. There has to be that trust building and that respect. And that's where I think that, we can't just go and take for granted that you're someone's financial advisor. That has to be earned, I believe. So I do think that it's really important for those advisors without succession plans, that it takes multiple years to build that rapport, to make sure that the clients, have that ability to, have that time to build trust. I think it's common courtesy a lot of times as well.
Well, it's interesting. So we are actually in the discussions with a couple of advisors who are thinking about retirement. Do you know what the number one thing that they want to make sure happens?
I'm sure it's take care of the clients.
They want their client taken care of. Why? Because they're now friends. I mean, they're family members. It's their own stuff that they're going to have. They want to make sure that their clients have a great experience and are well serviced ethically when they're gone. And so it's just an interesting discussion. So as I'm saying that, so that as our listeners are out there and they happen to come across other advisors who are thinking about retiring and they want to make sure their clients are taken care of, we are certainly open to talking to any of them.
Absolutely.
So we've run out of time here today. I do want to make a mention that in the next few weeks, banks are going to begin requesting information from employers who receive funds from the Paycheck Protection Plan, the PPP, to see if they qualify for loan forgiveness from the SBA. The rules continue to change. It was originally that 75% of the money that went to payroll would be forgiven. Then they lowered that to 60%. Now they just came out with a new program that if you elect going from using the money over 8 weeks, but you do it over 24 weeks, that they'll forgive up to $20,888 per employee. So these rules are constantly changing. So what we're going to do is in the next couple of weeks, we're going to have a guest speaker from one of the banks participating in this program from Citizens National Bank. We're going to have a speaker come and talk about what the banks are doing with regards to that process and what's happening to the funds that people are actually getting. Mm-hmm. So I want to remind our listeners that any of the discussions that we've had today about specific stocks or mutual funds are not an endorsement to buy or sell, but simply commentary based upon each commentator's opinion, and that all investments have risks and past performance is not indicative of future results. That being said, we remind everyone that these weekly broadcasts are open to the public. So we welcome you, the opportunity for you to share our links to this broadcast on your social media with your friends or family, because everybody's welcome to listen and learn our perspective on the market and the economy.
And no worries, Aaron will be back in this seat, the hot seat, next week. So
I think you did a wonderful job today, Brian, and we appreciate your perspective as one who's actually out there advising clients. So as Brian and I discussed today, if you know other advisors from firms who are thinking about retiring, you're welcome the chance to speak to them. And if you have any questions for your lead advisors after this broadcast, they are here and welcome your phone calls. So have a great 4th of July weekend with your family. We see them here on our screen. So thank you to all of our listeners, and so long for now.